Here at FS Investments, we've always been focused on democratizing alternatives for our clients. Democratizing alternatives gives clients tools other than traditional stocks and bonds. We all know it's been a challenging market environment. It's very difficult to build portfolios today given that 60-40 is broken. Investors still need solutions, and FSCO may offer a differentiated income and total return source for many investors. Andrew, you've invested through multiple credit cycles in your career. Why do you think now is the time for investors to embrace FSCO given where we are in this current credit cycle?
The macro environment has largely trumped financials in terms of what's driving volatility and investor sentiment this year. It's a market where flexibility and investment discipline are critical to protecting capital and driving return. As we see dispersion, we are presented with a unique opportunity to seek, to track, and capture those trends. We believe we have the tools and resources to identify the outperformers to seek enhanced returns. With that as the backdrop, we believe we have a strategy and credit platform built to thrive across challenging environments and capitalize on opportunities by the volatility we're seeing.
You mentioned dispersion. Can you explain what that means and why that's important to investors?
For me, dispersion means valuations, prices, and credit spreads that are different amongst asset classes, and for our fund, somewhat similar asset classes. So I think about valuations and spreads in senior secured bonds versus senior secured loans, in public senior secured loans versus private senior secured loans, etc. And when we see periods of volatility, we often see certain pockets have valuations that get disconnected from other pockets. And that provides an opportunity for us to rotate capital to those areas of the market where that dislocation has occurred, and not necessarily take any more risk because it's a comparable asset.
You've had so much success in your career. What can investors expect from you and your team over the next several years?
They should expect an attractive dividend in contrast to treasuries and plain vanilla fixed income. As credit investors, we're always thinking about the downside and appropriate level of risk versus the upside. Our goal is to generate strong risk-adjusted total returns.
So with FSCO, you have a very flexible strategy that can invest across the capital structure, publics and privates, and even take advantage of distressed opportunities. On top of that, you're going to have an approximate 9% dividend yield. What are some of the opportunities going forward that you're so excited about?
First and foremost, our performance reflects our ability to tap into the infrastructure, relationships, and resources of FS Investments' $34 billion asset management platform. We believe there's a tremendous amount of value that accrues to our investors from this.
It's always been fascinating to me to study how individual investors and teams of investors make thoughtful investments at the right time. Can you walk us through the logistics of how that takes place with you and your team from a strategy perspective?
Flexibility is the key word. We're not constrained to a specific market or asset classes as markets change. We invest across loans, bonds, structured credit, and highly structured equity investments with a focus on non-traditional public and private credit. We go where we see the best opportunity and try to extract a return premium in those areas.
This concept of extracting a premium or an excess return premium, can you explain what that means to you and why it should be important to our investors?
Our bread and butter is investing in opportunities that often require significant expertise and resources to source and analyze due to the complexity of a balance sheet, a lack of publicly available information, or illiquidity of the asset. By having a team and a fund structure that invest in those areas, we seek to tap into those opportunities for a return premium. And those opportunities contain those return premiums because many traditional investors don't have the ability to underwrite them.
Having reviewed hedge fund managers and other alternatives my entire career, I've always noticed that it's even rare for institutional investors to be able to access managers that can invest in both private and public strategies simultaneously. Why is this such a key advantage for FSCO delivering consistent absolute returns to investors going forward?
The last 12 to 18 months provide a good case study for this. In 2021, the public markets weren't overly compelling. Tight spreads, lower yields, and generally benign conditions. We focused on the private markets where we saw potential to earn a return premium relative to the public markets in highly structured transactions that gave us more downside protection than public instruments provided at that time.
We always talk in our investment committee meetings about the speed and magnitude of moves in markets this year. It's very unprecedented at many levels. How has your view changed throughout this year, and how is that going to impact new investments you make going forward for investors in FSCO?
This year, we've been seeing a bit of the opposite with widening credit spreads, higher yields, and greater dispersion across sectors in the public markets. So there have been some attractive entry points where in the new issue market, where banks are looking to syndicate deals inked earlier this year in high quality names in out of favor sectors that have traded down somewhat significantly.
Andrew, you just gave a brilliant explanation for the different dials that you turn in the portfolio at different times. Which dials right now are you particularly using to continue to generate very attractive income while minimizing risk of loss to our investors?
We've turned the dials to defensive positioning with a high allocation of senior secured debt as well as a lower duration. In a rising rate environment, we've dialed up floating rate allocation to have a lower interest rate duration as well, with an interest rate duration today just above 1 year.
So Andrew, with FSCO, you've discussed how flexible the strategy is between privates and publics and why this helps you generate an approximate 9% yield for investors. Do you think right now that's something that investors should consider to add to their portfolio? And how confident are you that you can increase this or maintain it going forward?
I believe we'll be able to maintain that and potentially increase it for a number of different reasons. Number one, we've done that historically. Number two, it's really all about the bottoms-up investing, and I've spent my entire career going out looking for investment opportunities that have a return profile in that range or higher. And we've always been successful in finding these idiosyncratic opportunities that provide for those types of returns. And number three, right now the wind is at our back with what interest rates are projected to do. So interest rates have been rising, and the forward curve shows that rates will continue to come up. And if you run the forward curve through our portfolio, and our portfolio is currently producing 9%, that forward curve should allow for even higher potential returns.